Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we are putting Casey's General Stores on the anvil. We're going to stress test their latest earnings report. Our mission? To figure out if this company is built from solid steel or if it's just a piece of scrap metal that's been painted to look strong for Wall Street. Let's get to it.
So Casey's just dropped their Q3 earnings, and right off the bat, the numbers present a paradox that could easily, and I mean easily, fool weaker, less disciplined investors. It's a classic Wall Street riddle, really. You have a company that on one hand appears to be shrinking its sales, but on the other, looks like it's getting structurally stronger, more profitable. For the untrained eye, it's just confusing noise. But for us, well, for us, it's an opportunity. It's an opportunity to dig deep and find the truth hiding behind the headlines.
And that really is the central question, isn't it? That's exactly what I see when I look at this report. It feels like walking up to a building that has a brand new shiny roof, but when you look down, you see cracks forming in the foundation. So you have to ask, is this real, durable strength that can actually withstand a market storm? Or is this just a short-term patch job? Some financial engineering designed to look good for a single quarter? Because let's be honest, hype doesn't build a portfolio that lasts. Durable, repeatable profit does. And I'm going to be honest, I need to be convinced that what we're seeing here is durable. Okay, let's break this down right here because this slide shows the paradox that has the market completely confused, totally paralyzed. Just look at these two numbers side by side. On the left, the bottom line, a massive 16% earnings beat. I mean, they didn't just scrape past the estimate, they absolutely blew past it. But then you look right next to it on the right side at the top line revenue, and it's a miss. A pretty significant one. Now, amateurs, they look at that revenue miss and they get spooked. They sell. The professionals, though? They see that earnings beat, and they want to know exactly where that power is coming from. Our job today is to drill down, to inspect the load-bearing walls of this company, and to determine, once and for all, if this structure is sound or if there are dangerous cracks in the armor. Okay, let's get into the engine room. First things first, the first place we have to look for real underlying strength is inside the store. We have to get away from the noise and the volatility of the gas pumps. This is the core of the business, where Casey's has been telling this big story for years now, a story about transforming from just another gas station into a legitimate destination, a restaurant, a local grocery. So we're here to find out if that story is a fact or if it's just fiction. 4%. Okay, I see that number, and frankly, I'm not impressed. Not at all. 4% is solid, I guess, but it's not spectacular. In this inflationary environment, you could argue it's just keeping pace, maybe slightly ahead, but it certainly doesn't scream 16% earnings beat to me. It doesn't explain how they just completely crushed the earnings number. This feels like maintenance-level growth, just keeping the lights on. So the question remains, where is the heavy lifting actually being done? Something else has to be driving this massive profit surge. The heavy lifting is right here. It's on this table. You're focusing on the sales number, the top line, but the real story, the one that matters, is the profitability of those sales. Look at that inside margin on the top row. It jumped from 40.9% last year to 42.2% this year. That is an expansion of 130 basis points. Now, for everyone watching, that means for every single dollar in sales they make inside the store, they are keeping 1.3 cents more in profit than they did just a year ago. It sounds small, I know, but when you multiply that by billions of dollars in sales, it becomes a tidal wave of pure profit. And you can see it right there. That small change in margin drove the inside gross profit up by nearly 9%. They're not just selling a little more pizza and a few more donuts, they are fundamentally re-engineering their business to make significantly more profit on every single item sold. That is pure operational discipline. So, management is out there claiming this is all part of a deliberate strategy, that it's not some lucky break. They're saying they've found the secret sauce, focusing on high-margin prepared foods, optimizing their supply chains, implementing smarter pricing. They want us to believe they're intentionally building a more profitable machine. And okay, I'll grant you, that margin expansion is impressive. It really is. But can that one part of the business truly carry the whole company? The Insight Store is only one piece of the puzzle. The big ticket item, the number that really, truly moves the needle on that top-line revenue, is fuel. And that's exactly where they missed. So let's talk about the fuel business.
All right, let's move from the kitchen to the fuel tank and see how this story builds. This is where top-line revenue lives or dies. And it's the exact place where the skeptics are going to point to find weakness. They see that revenue miss and they immediately assume the business is faltering. But again, it's because they're looking at the wrong part of the dashboard. So let's pop the hood and check the real diagnostics on this thing. See?
And there it is, the smoking gun. Barely positive, 0.4%. They're not exactly pumping a river of new fuel sales, are they? This looks like a serious weakness. In fact, you can call it what it is, stagnation. You can't claim to be growing a business if you're not selling more of your primary product. This right here is the source of the revenue miss everyone's talking about. And to me, it looks like a fundamental problem with customer demand. You simply can't argue with that number. It's practically flat. Now, that's only half the story. You're completely focused on volume. But the real metric, the one that builds a strong portfolio, is profitability. While the rest of the market was obsessed with how many gallons they were selling, CASY's was laser-focused on how much profit they were making on each and every one of those gallons. Just look at the right side of this slide. Total fuel gross profit is up over 15% on that same flat volume. That isn't a sign of weakness. That is the sign of an incredibly disciplined, profit-focused operation. They are refusing to chase empty volume with margin-crushing discounts and price wars. It's a game of chess, not checkers. Okay, a 41-cent per gallon fuel margin is incredibly strong. I mean, you absolutely have to give them that. Most of their competitors would kill for that number, and they're holding that line quarter after quarter. So I see the strategy, I get it. Prioritize high-quality profit over empty, low-margin volume. And it's clearly working for them. But here's the thing. A profitable machine needs to be maintained, and maintenance costs money. A high-performance engine burns more fuel and requires a lot more upkeep. So my next question is, are they managing their expenses? Or are the costs of running this high-margin operation spinning out of control? That's the next potential crack I'm looking for. That is a fair question. A very fair question. A powerful engine is absolutely useless if the chassis holding it is rusting out from underneath. You can have the best margins in the entire world, but if your cost structure is bloated and inefficient, it will all eventually turn to dust. So let's run a proper stress test on their operational structure. Let's get this thing up on the lift and see if the foundation can actually handle the weight of this powerful profit engine. And here's what concerns me. Now, we have to look back at the previous quarter's report to see the expense trend line, and what we find is that costs are climbing, and they're climbing fast. Total operating expenses were up almost 17% year over year. Now, of course, the company will tell you most of that is from opening new stores, and that's fair, that's growth, but you have to look deeper. Same-store employee expenses are up because of higher wages and a tight labor market. Incentive compensation is up because they're paying out big bonuses for this, quote, strong financial performance. These aren't one-time costs. These are real structural costs that eat directly into that beautiful bottom line we were just admiring. So is this sustainable? Or are we seeing the beginning of some serious stress fractures forming in the balance sheet? That's not a stress fracture. That's a load-bearing wall, and believe me, it is built to last. Let's talk about the balance sheet for a second because this number is crucial. They have $1.4 billion in available liquidity. This isn't some company scraping by, living paycheck to paycheck, quarter to quarter. This is a fortress with a massive war chest. They have the capital to absorb rising labor costs, to invest in their stores, to pay their people well, and to continue expanding their footprint. This level of liquidity gives them immense flexibility and durability. They can withstand economic headwinds and continue to execute their high-margin strategy without even breaking a sweat. And look at how they are deploying that capital. This is what you want to see. In Q3 alone, they went out and repurchased $76 million of their own stock and approved another dividend for shareholders. This isn't just talk from an earnings call. This is management putting their money where their mouth is, and it signals absolute confidence in the future. These are not the actions of a management team that is worried about rising costs or a potential downturn. They are so confident in their future cash flow that they are actively returning capital to shareholders while still investing in growth. That speaks volumes about what they see coming down the road. Okay, I see the confidence and I see the capital returns, which are hard to argue with. But this right here is where they might be getting a little too far out over their skis. Raising their full-year EBITDA guidance to a range of 18 to 20% growth, all while revenue is soft, that seems incredibly ambitious. They're essentially going to the market and promising they can keep squeezing more and more profit out of every single transaction, quarter after quarter without fail. That is a very high bar to clear. It leaves absolutely no room for error. One slip-up, just 1 quarter of margin compression, and the market will punish them severely for overpromising.
All right, we've inspected the foundation, we've stress-tested the beams, we've listened to every one of the skeptics' concerns, and we've analyzed the company's blueprints. We've looked at the sales, we've looked at the margins, the costs, and the all-important balance sheet. Now it's time to cut through all the noise and give you our final iron financial verdict.
And this is really where it gets real for anyone with money on the line. The market was completely neutral, totally flat after the announcement. The stock barely moved.
Wall Street is paralyzed, completely unsure how to weigh the powerful profit beat against that weak-looking sales miss. So, what is the real story here? After all of our analysis, have we found a solid, durable investment, or is this just a value trap waiting to spring on unsuspecting investors?
Our verdict. It's an opportunity. The revenue miss is a complete distraction. It's a smokescreen that is hiding the real story, and frankly, the market is falling for it. The real story here is the structural integrity of this business model. This isn't a company that's just getting lucky with a favorable gas price environment for one quarter. No, this is a company executing a disciplined, repeatable, high-margin strategy that is forged to withstand market pressure. So here are the key takeaways from our stress test. This is why the entire structure holds up. First, they exhibit elite margin discipline. They are masters of profitability, both at the gas pump and inside the store. Second, their capital allocation strategy is a powerful testament to their financial strength and their confidence. They are actively rewarding shareholders. And third, the business model itself is becoming more and more resilient. By focusing on prepared food, they are creating a destination, not just a simple pit stop. And that builds a loyal customer base that is far less sensitive to the price of gas. So while other people focus on that top-line miss, the smart money sees the rock-solid profitability being forged underneath. This is exactly what building a durable portfolio is all about. And that's the billion-dollar question for you, the investor, isn't it? Is the market missing the story here? Our deep dive analysis suggests there is a profound structural strength in this company that the headline numbers are currently obscuring. It's up to you to decide if you agree with that assessment. Thanks for watching. For Iron Financial, we'll see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.